For 20-year-olds, those who are 20 years of age, average 401k balance right now is about $4,400. For 25-year-olds, the average 401k balance, a little over $15,600. And for 30-year-olds, the average 401k balance, about $35,000. Brian, are these numbers impressive, not impressive? You like these?
No,
like these? How do you feel about this?
Look, this is the decade to get serious about this, because your 20s is the decade you should be investing in building assets, not liabilities. Is because I got to tell you, it troubles me that you're a billionaire of time at this age, and yet people are not even reaching a savings rate. And here's a stat that will freak you out. I put this in conjunction with when we get data from the government that shows that really people only have assets in two places: their home, and then now it's starting to make me think only in their employer-provided 401k, because we find out that half of Americans report never having invested outside of their 401k, meaning that this is it. You basically got your house, and then you probably, because you didn't want to miss out on that free money from your employer, we want you to go beyond that. And that's why I love that we get to do content to get you outside of that so you can maximize every dollar that comes into your army of dollar bills.
Yeah, we know if you're a financial mutant and you've been following the financial order, Brian, you know the financial order operations? Not only are you going to take advantage of your 401k, but you're also going to be using HSAs and Roth IRAs and other types of investment vehicles. So what we want to compare for you is, where should you be? Where should your liquid net worth be when you look at all of your investments, not just your 401k? And we want to compare that to the 50% of Americans who only have access to a 401k. And so you may be asking the question, well, how much do I need? And ultimately, the answer is, it depends. Yeah. It depends on your unique situation. But what we want to do is we want to give you some mile markers, some posts to kind of walk you through where you should be on your journey. And we know we've shared this on the show a ton, that by the time that you're 30 years old, we say that we want you to have about 1 times your annual salary saved up. And I think that's pretty common knowledge. I think Fidelity agrees with that. We agree with that. I think it's not an incredibly difficult thing for most folks to do by the time they get to age 30.
So with that, if you put that context in there, we showed that by the Fidelity data was around $30,000, a little over $30,000, and we know the median income is over $50,000. There seems to be somewhat of a disconnect there.
So we know if we want to start at age 30 with about 1 times our salary, and ultimately if we're trying to work towards age 65, a traditional retirement, when we want to be able to replace 80% of our pre-retirement income with a 4% withdrawal rate, our goal by the time that we get to financial independence, we get to retirement, would probably be somewhere around 20 times our annual salary. So we got to figure out, how do we go from 1 times our salary at age 30 to 20 times our salary at age 65? What are the mile markers? What are the marks we ought to hit? So if we think about folks in their 20s, we know that right now the median income for someone in their 20s is about $54,000, almost $55,000 a year. Well, if you remember, the average 401k for someone who's 20 is about $4,400. At 25, it's about $15,600. Brian, you just alluded to this. The average 401k balance is about $35,000. If you're going to be a financial mutant, you want to hit the money guy mile marker, we actually want your total investable net worth to equal 1 times your annual income. And if you're just a median income earner in this country, that means that you should have about $55,000 in savings and investments by the time you get to age 30.
Well, and that's what I want 20-year-olds to know. It's okay if you're aspirational. We tell you we love for your savings rate to be 25%, but we understand when you're just starting out, it's okay if you're just doing 5% initially, just so you get that employer match, or 6% to get load up on the employer match from your 401k. Just do something.
That's right.
Because a little is going to go a long way. And that's why we wanted to bring it back to, if 20-year-olds are feeling like they watch this content and they feel like they're a little behind, how can they catch up? We ought to give them what they can focus on.
Yeah, so what are the things that really ought to consume your attention? Well, in your 20s, we really think it's mostly about behavior. Are you beginning to build and establish the good habits that are going to carry you through the rest of your financial life? And the first one seems so common sense, and yet so many people miss this. Are you living below your means? Are you making sure that whatever you have coming in is more than you have going out? If you're not at least doing that, you're missing out on the very first ingredient of wealth creation?
Well, it's discipline. I mean, that's one of the things. If you can, I'll go ahead and tell you, when we work with clients, prospects come our way and we work with clients, you see an abundance of people who have made really good disciplined decisions throughout their entire financial life. If you're constantly running up credit card debt, if you're constantly just making minimum payments, you're never, ever going to get ahead. So I want to give you that stark, honest truth so that you can start living that disciplined life and figure out how do you create margin in your life so your money can actually start working, and giving it that third component, which is the time to build upon itself.
Now, I love it. You just said it. So most people, they don't live below their means. They do exactly what you said. They start getting in debt. So if you're in your 20s, you're trying to think about what are the things I should focus on. Number one is don't allow your debt to begin accumulating. A lot of folks have to graduate with student loan debt. It's a new reality for our graduates coming out. What we don't want you to do is come out of school and start your career and have student loan debt, and then you start adding the auto debt, and then you start adding the credit card debt, and then you start adding the consumer debt, and all of a sudden you recognize in this decade when you should have been building assets, all you were doing was digging a hole that got deeper and deeper and deeper. So in your 20s, you want to make sure you're not falling into that trap.
And that leads right into measure twice on large purchases. This is because you don't want to make a mistake on, I see it all the time. You know, you graduate with college, you feel like, you know, maybe you grew up in humble beginnings. You reward yourself with that brand new car payment. And we see average American now doing close to 66 months on financing, payments over $700. Guys, don't go fall into that consumption trap. Measure twice on those large purchases, because you do not want to be driving your wealth around. So you want to have it in the net worth statement.
Yeah, in your 20s, we said, okay, don't live beyond your means. Don't go into debt. Don't screw up the large purchases. How about one do? Here's a big do to focus on in your 20s. Do start saving and investing, even if it's small, even if it seems insignificant. What's amazing about your 20s that even small, insignificant numbers, when applied through time, can become incredibly significant. That's why, Brian, we even come up with this idea, this concept called the wealth multiplier.
Yeah, if you think about it, for a 20-year-old, every dollar that comes into your control has the opportunity to become $88 by retirement. But here's the thing, that excitement, it can also be something that cuts the other way. By 30, you see every dollar has potential to be $23. Right. Still really exciting stuff. But notice by the time you're 40, 7. So a 7-fold increase is still important. But by the time you get to my age, now you're getting below $3.
It's not the same.
This is why time can be your friend or it can be your foe. Make sure you go download moneyguy.com/resources, our wealth multiplier, to make sure you're on the right side of this.
All right, so we're talking about the 401k and how powerful it can be. So for those in your 20s, what are the things as it relates to your 401k that you should really be familiar with, that you should really understand? And we think that there's 3 of them. Number 1 is your match. Number 2 is your contributions or what you're putting into the plan. And number 3 is your investment. So let's talk about the first one first, Brian. Let's talk about the match, because this is one I know that gets you super, super excited.
Yeah, this is, and I've already alluded to it. My excitement got too much and overwhelmed me in the fact that I bursted out with, you have to love the free money. Yes, your employer is incentivized to give you matching or profit sharing, or even just, you don't even have to put money in. They just put money into your plan so they get to do even more options with their plan for themselves. Don't sleep on the free money. That is so powerful. That's why it's number 2 in our financial order of operations.
And would you believe that right now the average employer contribution is 4.7%? So if you're someone who's just taking advantage of the match, just putting money into your plan, there's a good chance that your employer is putting nearly 5% in there on your behalf. And this is often structured as like a dollar for dollar match. If you put in $1, your employer will put in $1. Or maybe it's a 50% match that if you put in 6% of your salary, they'll put in 3%. Either way, you can think about this like a 50% or 100% rate of return on your dollar. So if you're not taking advantage of it, if you're leaving money on the table, you are literally walking away from free money. And you already alluded to this, Brian. There's a few different types of ways that your employer can put money into the account. We just talked about this one. It's matching. It's where you have some skin in the game and your employer says, okay, if you've got skin in the game, I'll put money in also. But that's not the only type of contribution.
Yeah, we also have non-elective. A lot of people are, if you think about it, it's not uncommon to see safe harbor 401ks. Well, safe harbors give really big flexibility to your employer if they just load you up with the money very early on. You know, some plans you have to put nothing in, so you can do non-elective contributions. That means that even if you don't contribute, they'll put money into your plan.
And then there's also profit sharing contributions where the employer says, okay, in addition to the matching or in addition to the safe harbor, maybe the firm, the company, the enterprise is doing well, so we want you to share in a portion of that. So we're going to put in additional contributions on your behalf. We have one plan, Brian, that is so generous that if you as a participant put in 5% of your pay, you actually get a total of 15% going in on your behalf across the matching contributions and profit sharing. So you need to understand all the different ways that your employer can put money into the plan. But then you also need to understand, how do you put money into the plan? What do your contributions look like? And this is generally broken down into two different pieces. Number one, how much do you contribute? And number two, where does my contribution actually go? What part of the plan do I actually put my dollars into?
Now, this next one, I got excited, and I'll just go ahead and reveal it for you. We looked into it because Fidelity, once again, was tracking all this data. The average contribution across all ages for 401ks, according to Fidelity, is 14.1%.
That sounds amazing. We're only 10% off of our 25% goal.
But stop. You can't have a celebration on this because, remember, we showed you just a few slides ago, employers are putting in close to 5%. So if you actually, and by the way, this number 14.1% does include the employer contribution. That means the typical American is actually putting in less than 10%. Right. Now, yet we all want a retirement. We all want to own our time, but yet we're not willing to put in the effort of actually going beyond that 9%. We can do better than that.
And there is some silver lining here. We actually know that 39% of people increase their contribution rate over the past year. So folks are getting better at saving, and we want you to do that, but remember, we don't want you to get your order out of line. Brian, can you hold the thing up again? Yeah. If you have high interest debt, we don't want you focusing on the 401k yet. If you have not fully built an emergency fund, we don't want you focusing on the 401k. If you've not fully maxed out your Roth IRAs, your HSAs, we don't want you focusing on the 401k. But if you are in step 6 and you are following the financial order of operations, this is the great time for you to begin thinking about, okay, how can I start contributing? How can I get better? Maybe I can't do 25% right out of the gate, but maybe I can start at 10%. And next year I can go to 11. And the next year I can go to 12. And I can slowly through time increase it and ultimately work towards that 25%
well, yeah,
goal.
I mean, it's okay if you start with just your employer match. It's just as you get pay raises, as your income goes up, try to do more. I mean, that's the thing is I encourage people as life happens, as you have more success, make sure that you're also updating those 401k contributions so that it is expanding as well. So you're just not stuck at that original 5 to 6% that you set up once you lined up your first 401k.
So that's your contributions in terms of how much you contribute. The other thing you have to think about is, which account do I contribute to? Which side of the equation? Because 401ks generally come in two varieties. You can do a pre-tax 401k where you put money in today and you get a tax benefit today, and when you pull it out in retirement, you pay taxes, or you can put it in on the Roth side. I don't get a current year tax benefit, but the dollars will grow tax deferred. And then if I pull them out for qualified reasons or qualified circumstances later on in retirement, I can actually pull them out completely tax free. So the question becomes, how do I decide? How do I know if I do pre-tax or Roth contributions?
Now, there's several things that go into this. Obviously, your age. This I will tell you, the younger you are and the more time you can let your money work, that is going to lean towards becoming tax-free growth, like a Roth account. But we also put an income component to it as well. It's because if you're starting out and you're not in your peak earning years, more than likely your tax rate is under 25%. Under 25% tax rate lends itself to being Roth friendly, meaning that wouldn't it be great if you could pay really low taxes right now, let that money compound completely tax free to take advantage of it? I should probably get in and enjoy and maximize that. However, if you're somebody and your income starts going up and your marginal rate, both your federal as well as your local state that you pay income taxes, if you add up what the next dollar tax for each one of those, that's your marginal tax rate, and it's between 25 and 30%, that's where those other elements like your age and your goals are definitely going to start leaning into. Because like for a 25-year-old who's in the 26% bracket, you probably, hey, you might want to go into Roth because you're young. But if you're somebody who's 60 years of age, you might want to lean towards more of the traditional because you'll have opportunities once you quit working to do Roth conversions or something. And then if you're in the high income situation and your combined marginal rate is greater than 30%, we think that there's potential down the road for you to take the tax deduction now and then later on, once you lose all your earned income, have an opportunity to do Roth conversions or even at least have the opportunity to pay a lower tax rate so it makes more sense. Take advantage of the arbitrage of, take the tax deduction now and then we'll figure it out once you get closer to retirement.
All right, so we're talking about the things you need to know about 401ks. We covered that you need to know about your match. You need to know about your contributions. The other thing we want you to know is about your investments. A lot of times, and it's super sad when we see this, someone won't take an active role in at least making the election in their 401k. So if you're someone in your 20s or your 30s and you're just letting your plan default to the cash option or the stable value option, there's a really good chance that you are missing out on a huge opportunity. Remember, we've already shared the wealth multiplier would suggest that for a 20-year-old, $1 has the ability to turn into $88. Well, that assumes that $1 is invested, that $1 is working for it. If you have it sitting in a money market or a cash equivalent, that $1 is not going to turn into 88. So you don't have to make this more complicated than it is. A lot of plans have really good, low-cost target retirement index funds where all you have to do is decide two things. How much can I save? When do I want to retire? When do I think I'm going to need this money? If you can just answer those two questions, you can set it and forget it and let your dollars start growing through time.
Yeah, in your 20s, I want you, because you're not supposed to touch this money for decades in the future. We want you to be more aggressive. Don't let the volatility or the news media scare you into being super conservative or going cash only. Consider looking at what the long-term investment opportunity is and be somewhat aggressive with it.